There is a stablecoin out there that doesn't hold a single dollar in its bank account. No cash, no treasury bills, nothing like that. Instead, it uses a hedge fund strategy that's been around for decades to synthetically recreate the value of a dollar, purely on-chain. It's called USDe, and it's now the largest non-fiat backed stablecoins in crypto at around $6 billion in supply. So how does a stablecoin with $0 behind it actually stay worth a dollar? Let's break it down in this video. USDe comes from Ethena Labs, founded in 2023 by Guy Young, someone who spends almost a decade in traditional finance and before crypto, including several years at Cerberus Capital Management, a $50 billion investment firm, where he worked in principal investments and private equity. That background actually matters because USDe's design borrows directly from a strategy institutional trading desk and hedge funds have used for years, not something invented from scratch in DeFi. The core idea actually traced back to an essay. In March 2023, Arthur Hayes, co-founder of the BitMEX exchange, published a piece called Dust on Cross, proposing what he called the Satoshi Nakamoto dollar, a fully decentralized stablecoin backed by a delta-neutral strategy, combining a long spot position with a short future position. Guy Young built the idea into an actual protocol. Hayes' family office, Maelstrom, ended up co-leading Ethena's seed round alongside Dragonfly Capital. Ethena went to raise about $156 million across multiple funding rounds with backing from a genuinely unusual mix for a crypto stablecoin project. Not just crypto-native names like Dragonfly, Binance Labs, and OKX Ventures, but also traditional finance players like Franklin Templeton and several other major derivative exchanges themselves. Deribit, Gemini, Kraken, and Bybit's venture arm, Mirana Ventures, all of whom notably are also the exact exchanges Ethena's hedging strategy depends on. USDe quietly launched in December 2023 and opened to the public in February 2024. By October 2025 peak, supply reached $14.7 billion, making it briefly the third largest stablecoins in the world, before contracting back down to around $6 billion following a stress event we'll get into later in this video. Here's the mechanism step by step. When you mint USDe, you deposit collateral, typically ETH, stake ETH, or SDETH, or Bitcoin, into the Ethena protocol. For every dollar of collateral you deposit, you receive 1 USDe, a straightforward one-to-one issuance. But here's actually the part that makes this different from a normal crypto collateralized stablecoins like DAI. Ethena doesn't just lock that collateral in a vault and hope its price don't crash. Instead, the protocol immediately opens a short position of equivalent size on a perpetual future exchange, betting against the exact asset it just received as collateral. This pairing of a long spot position with an equal and opposite short position is called a delta-neutral hedge. Let's make this more concrete. Say you deposit $100 worth of ETH to mint 100 USDe. Ethena simultaneously open a $100 short position on ETH perpetual futures. If ETH's price rises 10%, your collateral is now worth $110, but the short position loses roughly $10 because you're betting against a price that just went up. That result, still worth about $100. If ETH price falls 10% instead, your collateral drops to $90, but the short position gains about $10 since you profit when the price you're shorting drops. Net result, still about $100. Either direction, gains or losses, roughly cancels out, which is exactly why it's called delta neutral. The position's value doesn't meaningfully move with the price of the underlying asset. Redeeming actually works in reverse. You submit USDe, the protocol burns these tokens, closes the corresponding short position, and returns your original collateral, minus fees of course. Ethena states it earns no profit specifically from the act of minting or redeeming. Its revenue instead comes from a different source entirely, which is funding rates. On perpetual futures market, whichever side the trade is more crowded, long or short, typically has to pay a periodic funding fee to the other side to keep the future price anchored close to the actual spot price. Historically, crypto perpetual markets have skewed toward more traders being long than short, meaning that long pay short more often than not. Since Ethena is structurally always on the short side of ETH and BTC perpetual, it collects that funding payment, which becomes its revenue. That funding income plus staking rewards from holding SDETH is the actual engine generating USDE's yield, which gets distributed to anyone who stakes their USDE into SUSDE, the staked version of the USDE token, Ethena's yield-bearing version. One more structural detail worth knowing is that your collateral doesn't actually sit on the exchange where the short position lives. It's held in what Ethena calls off-exchange settlement providers, regulated custodians like Copper, and only delegated, not transferred to exchanges to serve as margin for the hedge. This distinction becomes very important later in this video. If you've watched our USD video, this might sound uncomfortably familiar. Another non-fiat stablecoin claiming to hold its flag through financial engineering rather than a pile of dollars in the bank. So let's be precise about what's actually different and probably what isn't. USD has no real asset backing it at all. Its back was maintained purely through an arbitrage mechanism with its sister token Luna. Burn USD to mint Luna, burn Luna to mint USD, with the entire system's value ultimately resting on confidence in Luna's own market price. That's what's called a self-referential or reflexive design. The thing backing the stablecoins was itself just another token whose value depended on people trusting the stablecoin, so kind of like a circle of sorts. When that trust broke, both collapsed together in a death spiral because there was no external assets underneath either of them to prop that trust back up. USDE is structurally different, however. Every USDE in circulation is backed by real collateral, ETH, SDETH, or Bitcoin, sitting in custody at all times at a 1:1 ratio. That collateral isn't a token Ethena's invented. It has value independent of USDE's own price. The short futures position isn't what backs USDE value, it's a hedge that stabilizes the value of collateral that was already real to begin with. That said, it's worth being fair rather than dismissive here. USDE isn't risk-free just because it's not USD. It shares a few things in common with algorithmic design that are worth naming honestly. Both rely on continuous, correctly functioning market infrastructure rather than a simple bank account. Both generate yield in ways that depends on market conditions staying favorable. USD needed anchors subsidized 19.5% to keep working, while USDE needs perpetual funding rate to stay positive on average over time. And both have faced genuine real-world stress events that tested whether the mechanism holds up outside of theory, which is entirely what next section is all about. So, can anything depeg USDE? Well, yes, and it already has, twice, in ways worth understanding in detail. February 2025, the Bybit hack. Bybit, one of the exchange Ethena uses for its short hedging position, suffered a $1.4 billion hack, one of the largest exchange hacks in crypto history. Ethena's exposure to Bybit at that time was limited to under $30 million, and because Ethena's collateral sits in off-exchange custody rather than directly on the exchange, none of USDE's actual backing was at risk. This is the payoff of that custody structure I mentioned in earlier section. It did exactly what it was designed to do, containing a genuine security disaster to a small manageable exposure. October 10 to 11, 2025, the flash crash. This one was more serious. A roughly $19 billion market-wide liquidation event hits crypto as a whole. On Binance specifically, USDE's price briefly cratered to somewhere between 65 and 67 cents, a genuine sharp depeg, while pricing on other venues showed a much smaller dip down to about 97 cents. The gap between those numbers is the key detail. This wasn't Ethena's underlying mechanism failing everywhere at once. It was a venue-specific liquidity and Oracle pricing breakdowns on one of the exchange during a moment of extreme cascading liquidations. USDE recovered within hours, but the confidence hit was real, Ethena's total value locked nearly half, dropping from 14.8 billion to 7.4 billion, with about $8 billion in outflow over the following 2 months as users de-risk themselves. If you want to see me doing a deep dive in how Binance actually effed up there, make sure to subscribe and click like, and make sure to continue on watching this video to the end. Beyond these two events, there are structural risks worth naming even without a specific incident attached. Negative funding rates, which historical data shows funding rates are positive roughly 79 to 84% of days, meaning USDe earns yield most of the time, but negative on the remaining 16 to 20%. During sustained negative stretches, Ethena's short position costs actually money instead of earning it, and the protocol has to lean on its reserve fund to cover the gap. Independent researchers at Llama Risk have flagged that this reserve fund could face a moderate risk of depletion under a prolonged, severe enough negative funding rate scenario, not a current crisis, but a real tail risk. Second, its redemption limits. Ethena has capped redemption at around $10 million per block, which is fine in normal conditions, but could force users to accept a worse price on secondary markets during a genuine rush for the exits, rather than redeeming cleanly through the protocol itself. The third is part of USD's collateral is USDe, which itself isn't actually perfectly pegged to ETH. It actually dropped to 0.93 ETH during the 2022 Terra collapse. A persistent USDe discount widens the gap between what Ethena's collateral is worth and what its short hedge assumes it's worth. The fourth is USDe's infrastructure has been audited by multiple firms, Spearbit, QuantStamp, and PassOff, with no critical issues surfaced through early 2026. But every additional moving parts, the staking contract, the minting contract, the custody integration, etc., is still more code, and more code is always more surface area for something to go eventually wrong. And if we look at the trend in 2026, it can go wrong massively. So how should you calculate the risk for Ethena? Well, USDe is not in the same risk category as USD in my personal opinion. It holds real independently valuable collateral, not a reflexive sister token, but it's also not in the same risk category as USDC and USDT. There's no bank account, no treasury bills, no simple redemption for cash, and USDe's stability depends on continuously functioning derivative markets, custody providers, and exchange infrastructure operating correctly 24/7 without interruption. And that's a meaningfully different and more complex risk surface than just we hold treasuries in a regulated custodial account, like most of the centralized stablecoins do. Obviously, this is not financial advice. I'm just talking to you guys about what my opinion is, and you can just cross-check my opinion as well. The most useful way to think about USDe isn't as a cash equivalent at all. It's closer to a structured market-neutral yield product that happens to trade near $1 and most of the time. That framing changed what it's appropriate for, money you genuinely can't afford to see dead, even briefly during a market-wide liquidation event. Probably doesn't belong in USDe or as USDe even. Money you're comfortably treating as a yield-generating position, where a short venue-specific wobble wouldn't actually hurt you because you're not trying to redeem it at exactly that moment, is actually a much better fit. If you do hold it, a few things are worth actually watching, not just knowing about ones. The trend in funding rates, which is persistently negative funding for weeks at a time, is your early warning sign or to exit that position. Not financial advice, again. The size of Ethena's reserve funds relative to the total USD supply is also make sure to check that number. And how concentrated the hedging is across exchanges. So more venues, more custody providers means less single point of value risk, which is exactly the lesson the February 2025 Bybit hack proved out of in practice. So that's it all for USDe video, and I hope you guys enjoy it. Make sure to check out my other two videos and stay safe guys, stay curious, and I'll see you guys next time. Bye bye.